Deal making has been steadily picking up in Silicon Valley. According to data firm CB Insights, there have been 11 sales of startups worth more than $1 billion. So that total is around $54.5 billion in sales. Compare that to a year ago. The first quarter of 2024 saw only 2 deals of that size with a total $3.2 billion. You had Google's $32 billion deal to buy Wiz as an outlier did mark a record for venture-backed startup sales. Here to talk about the deal landscape, joining us now, Matt Murphy, partner at Menlo Ventures. Matt, it's great to see you.
Great to be here. Thanks.
Big week. So does that align with what you're seeing in your experience? What has deal flow and activity looked like at Menlo?
It's been way up. I had 2 companies that I'd been on the board of for 10 years get offers. They were announced. So this was Ignite and DataStax about a month ago. So those were 2 companies over 10 years old. And then we have 2 transactions under sign now at Menlo. Another one probably in a couple weeks, both from public companies. And we had 2 other public companies make offers on our portfolio companies that we turned down. And I would say, so let's say that's 6 in a relatively concentrated period of time. I can think of maybe 1 last year. So wow. Anecdotally way up, and we can talk more about what's behind that.
Yeah, what is behind that? So it sounds like some of these buyers are strategic, public companies in a lot of cases. What's going on the buy side?
Yeah, well, I think first there's a lot of press around regulatory, and I think that's an issue, but it's probably a bit overstated in our world because that impacts the Wiz's of the world, right? Like Wiz called off the acquisition last year at $22 billion, turned out to be 32, good to wait, but I think that was really purely because of regulatory risk. But the run-of-the-mill transactions in the venture space, which is probably somewhere between like 200 million and somewhere a little over $1 billion, most of those weren't really impacted by regulatory factors. So I think it's really other things going on. And it's really like we had this SaaS recession a couple of years ago. So a lot of public software companies, their market caps fell, so their valuation was down, made it harder for them to buy companies. They had to get their house in order. So they look and they're like, well, we now have to move from grow at any cost to more profitability. So they have to clean up their P&L before they can absorb the P&L of a startup that, you know, almost by definition is losing money. So the buy side has become much more interested, and probably even maybe trumping even all of that is that they know this is the wave of AI that they can't miss out on. So they've kind of flipped more in this mode of playing offense. Like, I'm going to look at my product portfolio and say, I can't miss out on AI. Do I have the teams? Do I have the products to really win in this chapter of tech? Probably not, as it is now. So that's kind of buy side. And then supply side, i.e. the companies, like they went through the same thing. A lot of private companies, as you know, raised capital at very high prices. The outlier companies that were growing 80 to 100% decelerated to, let's say, 20, 30, and that really has a huge impact on your valuation. So those companies were in the mode of saying, I'm not going to think about selling until I get my house in order. So a lot of those companies, maybe they've gotten profitable, maybe they've gotten their growth rates back up to 40+%. So they've become much more interesting to be acquired. So it's kind of like supply and demand side is meeting each other in the middle a bit better than it was back then.
They've both sort of had this cooling off period where everybody got their stuff in order and then they're ready to go. What about valuations? Have any of these deals been happening at a discount, or how would you describe kind of prices out there right now?
Well, I think when there's not an active IPO market, you're kind of constrained on your liquidity options. So I do think that it's good that at least the IPO market seems to be opening up. You know, there's a number of filings that'll happen in the next few weeks that'll make that a little bit more apparent. Should be pretty exciting. But when a company has the option to go public, it makes a buyer realize that that company has an option, and they might have to pay a stretch, like let's say strategic premium to buy a company. So I think we're seeing more of that. Now that said, the IPO market is still very tricky. It's not for everybody. I wish it was. Like when the IPO market, when I started in the venture business, you could go public at $100 million of revenue and a 20% growth rate, and now it's more like 300 million plus with a 30, 40, 50% growth rate. So it's a little bit harder for the private companies to go public. But because of this wave of kind of companies getting their house in order and getting closer to profitability, it's not like these companies are running out of capital. They probably feel like they're accreting value even if they're growing 20, 30%, and they'd rather grow into that than take a big haircut on price. Now, that still might be below where they did their last round in the heyday of 21, 22, but still, so I wouldn't say that there's like, I would say the pricing environment's okay. It's enough to kind of meet in the middle and find a transaction. I think that's the two transactions that I had happen a month ago, Ignite and DataStax. Those were kind of good examples, and one was reported in the kind of $1.5 billion range. So you know, that's a pretty real outcome.
Over $1 billion. That kind of aligns with some of the data we're seeing.
Yeah.
Will prices get back to sort of the 2021 levels, or is this just a new normal and they've sort of reset and that is the market at this point?
Well, in the private market, they're already back there. I don't know if you were asking about that, but like
private market valuations.
Not like M&A outcomes a little bit too, but mainly like the private valuations right now. We went through this wave of a lot of lower growth companies, and again, the deal or velocity of new companies raising capital was down. There were some down rounds, all that. Now we're back in this extremely exciting wave, and it's always a double-edged sword. On the one hand, you're thrilled as a venture capitalist that there's this massive wave of AI, and you're seeing companies growing literally at extraordinary growth rates we've never seen before. Like the old model was you go from 1 and then you triple, double, and now you see companies going 1 to 10. We invested in a company not to be named that went from 1 to 50 in 1 year. And so these are just things that you don't really see before, but because of that potential, both because there's an amazing new wave to invest in, happens same thing around the mobile wave, maybe the cloud wave. You know, we've got this AI wave, and people realize there's going to be bigger outliers than we've seen in a long time. So that drives up valuations, and then these kind of crazy spiky revenue curves that I mentioned also drive up valuation. So it's pretty inflated right now, but I'd probably rather take that than one of those environments where you're looking around saying, gosh, nothing feels like special or spiky or whatever. So it's always a challenge.
Is that true outside of AI for maybe more traditional software or companies that just don't do AI at all? Are we sort of in this have and have-nots
It is,
market?
definitely. Yeah, I mean, in fact, we've seen a couple of companies recently, and it's like, well, you're a really good business, but what's your AI story? And I'm not saying every company, well, let's say like if you're not using AI, you have to ask yourself, why not?
Yeah.
But not every company has to be like an AI native first and AI native software company first, meaning like, hey, there's an agent in there or a co-pilot that replaces all this, but at least it should be a key part of your strategy. And when a company doesn't have that, frankly, just relative to the set of investment opportunities out there right now, it just seems less interesting. It's kind of like, well, I could do that, but then I can only make so many investments a year. Why do I want to do that when I can invest in this new amazing AI thing? So I think it's hard for those companies that haven't really figured that out yet.
What about secondary rounds? It seems like companies too, there's not the same pressure, I would think, from employees because they don't need to necessarily cash out. They can sell in a secondary. What effect is that having on venture markets?
Yeah, I mean, it's allowing companies to stay private longer, which in many cases is a good thing. Because if you're growing, you know, you're accreting value and creating value to your employees, investors, and so forth. But there used to be more pressure, like when I said before, where companies could go public at $100 million of revenue. You kind of getting them public, and maybe people sold their stock too soon. So I think in this era where secondaries have been more common, which is really only like the last 5 or so years that secondaries have become this common, it just allows employees to take a little bit off the table to kind of buy a house, take care of their family, things like that, but still ride the upside. So I think that's been a good and new thing for our industry. What
are you hearing from founders? Is there an urge to go public, or are they more comfortable just staying private for longer?
It really depends on the company. You know, I think there's like these massive outliers, like a Databricks and a Stripe, and they just feel like they basically have their own public market, right? Their stock is so liquid, and they've got so many shareholders. It's so easy for them to transact whatever they want. It's probably like, well, why should we go public? But you know, outside of that, I do think there are a lot of companies that would like to go public. There's a certain goal that every company has. It's kind of validating to be able to go public. I think, you know, there's a certain rigor that comes with it and discipline that says, hey, we're that kind of company that's ready to do that. There's obviously much broader liquidity, so for those reasons. So I would say, you know, it's probably like, you know, of the companies that are in that, of that scale, the vast majority, let's say 80%, would probably like to go public.
And the volatility in markets, is that scaring off any founders, or are they more long-term focused? There's been so much news around tariffs and...
Well, yeah, I mean, I think just generally volatility in markets are, you know, a key driver, and it's not for everybody, because like if you go public, you really have to have confidence of whatever your 3-year plan that it's going to happen, because if you trip up, then your valuation gets overly punished, and you look back and say, oh, I wish I'd taken that strategic acquisition, or in the case of Ignite, where I was on the board, a PE-based acquisition. It removes all of that long-term volatility. So I think it's really company dependent. Like how confident are you in that in that long-range plan, and then at the same time, did anybody come knocking with an offer that was really interesting or not?
What about the Wiz deal? We mentioned that in the intro. It seemed like such an outlier, but did that have an effect on sort of the psychology of deal making and prove what's possible for founders? It's just such a big number.
Yeah, I mean, it's such an outlier. It's hard to equate that to the I don't know, normal startup, if there is a normal, even a more later stage one, because that's just not the kind of valuation most companies can aspire to, even if you're an outlier company. But it's energizing. I mean, it's certainly, you look at that, or you look at the recent value of Anthropic and their $60 billion round. So, there's a ton of investors coming into this round that think $60 billion valuation is going to give them a high multiple, including us at Menlo Ventures, right? And so those are really exciting when you feel like if the potential or possibility is a tens of billions of dollars outcome, it's very energizing for our industry. But I think everyone has to realize, like the examples I gave you of the companies that I was on the board of for 10 years, those are 10-year companies, and they didn't trade for many, many billions. They traded in the billion range, and that's a really good outcome in our business. But it's certainly, you have to be careful of what your entry price is.
Yeah, definitely. We should mention you guys are an investor in Anthropic too.
Yes.
The regulatory environment, are you seeing green shoots? Not just the mega deals, but are there smaller changes in the regulatory environment you're expecting that would make it easier for strategic buyers to come in and for more deals to end up happening this year?
I think it's just people worry about it less, and maybe if you're a strategic buyer, let's say on the private side, we were worried the strategic buyer would say I only want to deal with the FTC once this year. I don't want to poke the bear too many times. So maybe they'd focus on that one big acquisition that they had to have instead of these 3 others that they might like to have. So I think it's more the mindset of that public company buyer, and it feels like that's kind of off the table in a good way. But more than anything, I really feel like it goes back to what we talked about earlier. There's just this mentality shift around, this is a huge wave of AI. As an incumbent, I need to play offense. There's a bunch of companies out there that are better suited for this wave than I am. We got to go buy them, and that's going to really lead to a lot more deal making.
How are you thinking about valuations and prices with all of this excitement and hype around some of the AI companies? How are you getting in at a reasonable entry point, and how do you know what that is at this point with some of the growth rates you're seeing?
Yeah. Well, we did this partnership with Anthropic called the Anthology Fund, which is a $100 million fund. So that's been a really nice way for us to kind of do a higher velocity of earlier stage seed investments. And so we get in early with somewhere between $250 and $2 million, and then watch how those companies mature, and then for our main fund, be able to pounce on those. And so it's a little bit of embedded or kind of proprietary deal flow in there. So that's one way. But overall, that's a hard question to answer, because there's a lot of other smart investors out there. There's a lot of people pursuing AI. I think, fortunately, we were one of the early movers there in the investment in Anthropic and the relationship and our team. So I think you have to be there early, have it be obvious why you're the right investor for them. You have a portfolio that makes sense to them. And then, the honest answer is it's a little bit more about winning these days than it is about optimizing, valuation. The valuation is hard to navigate around, but I think kind of being earlier where we are certainly helps that to some extent.
I think you and I have talked about this in the past, but the possibility of a bubble at this point, as you said, there's so much excitement around it. Does it matter if we're in a bubble for venture, because you just need that one big win? You need the power law to work out?
I'm glad you know that about our business, but yeah, I mean, it is kind of true that way. And I mean, it's somewhat dangerous thinking, because then it makes you can suspend any valuation discipline and just say hey, look, we just need to be in this basket of companies, and if a couple are winners, we're going to be fine. But some of these rounds where somebody's raising a $1 billion Series A, which I've never heard of before, or a $100 million Series A without proving a lot, we've already seen a couple of those transact for kind of money back, and maybe those investors would say, well, that doesn't really matter, because at least we got our money back. It was worth the option. But sometimes these one-way options where worst case we get our money back doesn't quite play out like that. So you have to be a little bit careful. But overall, I agree with you. Like, it's just, we are in a power outlier business, and you're much better off doing whatever it takes to be in those than not.
What are your expectations for the rest of this year? I guess it's only really April almost, but
Yeah.
More deal flow. What kind of deals are you looking to do? Give us sort of a glimpse of what you're looking at in the next, call it 6 months.
Yeah, well, so I would say, like, in a regular year, maybe we invest about one and a half companies per month, not including like the seed stuff that we're doing with the Anthology Fund. There was one period this year, about a month ago, where we put out 7 term sheets in 10 days.
Wow.
Just to give you a sense of the pace. And I wouldn't say, it wasn't like, oh wow, like we're all in some kind of frenzy and my partners and I have lost discipline. It was like really, really high quality opportunities. So AI first, industries that we're interested in, like healthcare and legal, and kind of automating various workflows. So it was like really good stuff, really good entrepreneurs with a novel approach. So I think what happened when the year started was we saw this second wave of AI companies. So last year was more like, I have an existing workflow and I've kind of bolted some AI on top. This year started out very much like the true agentic AI, where it was like, oh hey, you're actually doing something really different. Like the AI is dominating or defining the application versus being this bolt-on. And so a lot of those came out of the gate early in January. Fortunately, we did a lot of them. But I think that it'll slow down a little bit as we get into kind of the mid-year. There's kind of these waves where everyone raises. It's like, hey, it's January, February, the new year, and then like September and October is really busy. But that said, I do think like just everything going on in this industry is going to compound more and more through the year. When we talked earlier about just being blown away with all the feature set and functionality that Anthropic's building around the models, and that just makes developers able to do things faster, right? Because it's one thing to have the best model, which they do, but when you have this set of functionality that allows developers, prosumers, consumers to do really cool stuff faster, it opens up the market, and that's what's going on. And so, you know, last year kind of was the year of training and figuring it out. This year's like the year of inference. Like, we're in production, we're prime time. And so that's going to compound throughout the year. So I think the thing I'm most excited about is just to see when that gets into production, all these companies, big and small, move forward with AI in their applications. It's going to be just somewhat mind-boggling what we're going to see.
And at some of the stages you invest, are you finding that companies are growing faster and are more profitable? That's something Gary Tan was telling us when we were at the YC Demo Day. He said the cohort of companies was more profitable and just growing at a rate he had never seen. Is that consistent across what you're seeing?
I wonder if he really meant profitable. What I would
I guess
say,
growing revenue, not necessarily
what I would say is
yeah.
like burning less. So that we've definitely seen where, you know, before to scale a startup, you know, you scaled with engineers, and now you're scaling with AI. And so this one company we recently funded, you know, we were looking at kind of their financial plan and how they intended to build the company. It's like, yeah, we really think we only need 5 engineers for the first year. And it's like, to build everything you're building? And then they kind of walked us through their architecture and how they were using AI. And it's like, I guess that makes sense, and that's the new era and way of building things. So that's stark. I mean, before, just to put that in perspective, a normal company would probably have like 25 or 30 engineers by the end of the year, and they were still going to have 5. So the dynamics of how AI is helping companies move faster is pretty wild.
I wonder what that means for the labor market and the workforce, especially in tech, but I'm sure it will start to broaden out. Do you expect, you know, fewer engineers to need to exist in Silicon Valley? What does it mean?
You know, there's always both sides of this argument. One is, yes, that's true, and the other one is like every company has always been engineer constrained, and so maybe 5 is an outlier, and you know, maybe that company that used to grow to 30 actually wishes they had 50, and now they can have 25 plus AI and grow and build stuff even faster than they could. So I think, you know, in our world of venture, the competitive advantage is that company that can move fastest to build products that customers love, and that is what AI helps make happen faster, which is really, really exciting. So, and then, you know, we look at a lot of other things in vertical industries, like let's say legal and healthcare that I mentioned before, and you know, when you really dig into some of these jobs, take like a lawyer or a mental health professional, they spend half their time doing very like bureaucratic type work. So it's like, well, I need to I need to write up this case report. I need to get on the phone with somebody and vet whether they're a different client. I need to submit something to insurance. So I'm spending half my time really being a lawyer, or half my time being a mental health professional. What if AI did all of that, and I could just spend my time doing the thing I was trained to do? So that's really cool, because then they can see more patients, they can see more clients, stuff like that.
Hopefully we all get more productive.
Yes,
that would be a good
exactly.
outcome.
Yes.
Well, speaking of Matt, we'll let you get back to your day job. Thank you for coming in. It's great to see you.
Nice to see you. Thank you.